Hi, my name's Steve Clapham and welcome to another video in our Finance Demystified series. Now, what we're going to do this time is look further into the issue of intangible assets. And if you've not seen any of these videos before, just remind you, please go to our website, sign up for our free newsletter, get access to our free library, loads of resources, behindthebalancesheet.com. And there we also have some courses for private investors. They're really good. Have a look. But what we're going to talk about this time is goodwill. And when I did the last video talking about intangibles, I remember, hopefully you remember, that I talked about two types. One's internally generated and the other's acquired. And the main element of acquired intangible asset is goodwill. And I talked about the other categories, customer lists, brands, other terms for what really is just goodwill. And goodwill is very simple. You pay for almost every company, you'll pay more than the assets on the balance sheet. So let's just take a simple example. You're paying £100 for your neighbour's lemonade stall and it's got assets of £20 being a table. So you've bought a table which is £20, but obviously the company's worth more than the £20 because it's selling lemonade. And people come to it for lemonade, and that extra money, the excess over the £20, 100 minus the 20, the £80, that's what goodwill is. And you know, when you look at the goodwill on the balance sheet of a company, generally speaking, it's carried at quite a high value because goodwill isn't depreciated like other assets. What the company has to do is check each year that it's worth what they paid for it. And because management don't like writing down goodwill, because it makes them look stupid, because if you've written down your goodwill, by definition, it means you paid too much for the acquisition. Management don't like to look stupid, so they'll avoid this. One common trick they do is they will they'll buy a company and they'll merge it internally with an existing department, and they'll then say they cannot separate the cash flows from the company they've bought and the department that they've merged it into. And that enables them to, generally speaking, or often enables them to avoid the write-downs because the totality will be generating cash flows which will support the valuation of goodwill in the balance sheet. And that's all the accountants are interested in. And that's what you've got to remember. So when you look at most goodwill and intangible assets notes, the goodwill is by far the largest element. You can see here that it's 1171 opening amount out of 1223. So the rest of it's just noise, really. And so what I tend to do is I tend to read the notes very carefully because they'll talk about how the goodwill has been allocated to what they call CGUs, which are cash generating units. And you can see here that the largest element of goodwill is actually in Europe, which for this company is the slowest growing area, which means that the goodwill probably is quite vulnerable, but the company won't take a write down. So my message to you, goodwill is quite an esoteric thing because of course it's really just a weird accounting adjustment. It's just out there to make the balance sheet balance. But if you read the notes, it'll give you some clue as to the thinking of management. And I always look at this note because it gives me a clue as to whether the company's aggressive or conservative when it comes to its accounting. I hope you like this quick video, Finance Demystified series. If you like the video, please give it a like on YouTube, subscribe to the channel, and don't forget, visit the website behindthebalancesheet.com. Thanks for watching.